Do you find yourself in a common Roth conversion trap where you're constantly having to play catch up because your tax-deferred accounts are outpacing your Roth conversion strategy? Well, this catch-up trap is created based on when most people perform conversions. So if we step back a second and remember the reason we're performing Roth conversions, we are trying to lower our tax-deferred balances in order to make our retirement income strategy more tax efficient and also minimize RMDs that will later show up in retirement and again push us into given tax hurdles. Well, if we think about how most people perform Roth conversions, they wait until the end of the year. And so let's take an example where we have $1 million tax-deferred account, and we know at the beginning of the year we want to perform somewhere around a $100,000 Roth conversion. Well, this year is a classic example of this catch-up situation that so many people find themselves in. It's been a fantastic year for investment growth, and let's say that your tax-deferred accounts are up 15 to 20% this year. So we started out with $1 million portfolio at the beginning of the year, but by the time that we reach the end of the year performing that conversion, our tax-deferred accounts have now grown to $1,150,000 or even $1.2 million. And so that $100,000 conversion off a $1.15 million portfolio or $1.2 million portfolio leaves us with more money in our tax-deferred accounts than we had at the beginning of the year. And so this is a common trap that we see a lot of retirees fall into, and they find themselves performing Roth conversions but not having their Roth conversions really make that large of a dent within their tax-deferred accounts. And so in this video, we're going to talk about why this Roth conversion trap is created and what you can do in your situation to make sure that you avoid that trap and also lower tax-deferred balances moving forward into the future. Now, I'm going to make my head just a little bit smaller here so you guys can see the full screen. Now, the reason this Roth conversion catch-up trap is created is based on when most people perform conversions. So most advisors will recommend that you perform conversions at the end of the year. And this makes sense on the surface because we might know at the beginning of the year we want to perform somewhere between a $100,000 and $125,000 conversion, for example. But we're not sure what surprise income we might have throughout the year. We might have capital gains that are spit out from our taxable account. We might sell a given investment. We might have, again, a bonus or other income that we aren't predicting at the beginning of the year. And so most advisors will tell you to wait until December in order to perform that conversion because we will have the clearest picture of your situation and be able to get exact on that Roth conversion target. But if we think about it, this creates a situation that puts us in this common catch-up trap. The reason being is because, again, depending on how our tax-deferred accounts are invested, we hopefully expect growth out of those tax-deferred accounts. Now on the screen right now, I have annual returns for a 60-40 portfolio. And this isn't a recommendation that you should invest in a 60-40 portfolio. I'm just using this for illustrative purposes. Now let's say your tax-deferred account is fully invested in a 60-40 portfolio. Now on the screen here, we see there are 2 years since 2008 where a 60-40 portfolio would have lost money. 2008 and 10 years later, 2018. 1 year was obviously a very significant loss here, and 2018 was a very slight loss. Outside of that, for most years for a 60-40 portfolio, we see some pretty substantial growth within this portfolio. When we're performing conversions at the end of the year, we're performing conversions after we've seen all of this growth. So when we think about tax year and when we can perform that given conversion, performing a conversion at the beginning of the year allows us to get ahead of that growth and have that growth come within the Roth IRA rather than having it come within the tax-deferred account and then we're playing catch-up. And so this whole idea of performing conversions in January versus December, typically in the majority of time periods, results in more money within your Roth IRA, less money in your tax-deferred accounts, which again is the whole point of performing that Roth conversion strategy. Now again, there are a lot of details we'll cover towards the end of the video, so make sure that you watch until the end of the video. But the whole premise here is performing a part of your conversion or most of your conversion in January versus December oftentimes leads to more after-tax wealth for your situation. Now on the screen right here, I have a chart where we're looking all the way back to 1928, and we're looking at a 60-40 portfolio here, and we're looking at the difference between an end-of-the-year conversion or a start-of-the-year conversion. Now, the plan here is to convert $100,000 over 10 years. So basically what this chart is showing, in blue it's showing the ending value of a Roth IRA with start of the year conversions. In red, we're showing end of the year conversions. And again, we're basically looking at this where this 2010 target right here, this is assuming that you're invested in performing that conversion strategy from 2010 up until 2020. So it's a rolling 10-year period. And what we see on the screen here is the vast majority of the time, performing conversions at the beginning of the year leads to far more after-tax wealth than performing conversions at the end of the year. Now, there are a few time periods here that we can point out and see there is a large gap between end of the year versus start of the year conversions. 2010 is a great example here, going from 2010 to 2020. If we perform conversions at the start of the year, at the end of this 10-year period, our Roth IRA would be worth almost $2 million we see here, okay, from these $100,000 conversions over 10 years. Versus if we perform conversions at the end of the year, our Roth IRA would be worth a little bit less than $1.5 million. So there's almost $600,000 more that you would have within your Roth IRA. Now, a common objection that we are hearing right now, and I've seen other advisors post similar videos along this same line, is you should not be performing a Roth conversion right now. And here's the general premise. Right now, we are at all-time stock highs. And when we're at a stock drawdown, there's the opportunity to perform a conversion at essentially a discount. The idea here being that if the stock market is down 25%, if we think the stock market is going to recover from there, essentially if you're performing a conversion at that 25% drawdown, you are essentially getting a discount because as you perform that conversion, the recovery in stocks should happen inside that Roth IRA, thus supercharging your Roth conversion strategy. Now, where this objection breaks down is we don't actually know what the future holds within the stock market. We can't predict the stock market. And so if we think that we should not be performing a conversion right here just because the market is at an all-time high, what's to say we don't see an all-time high next year, the following year, and even for the next 5 years, we continue to step higher within the market? To say that we should not perform conversions right now because there's a high likelihood there will be a market crash next year is completely baffling to me. Because if you actually thought there was going to be a market crash next year, you would still perform a conversion this year. And you would then change your investments to no longer be invested in the stock market, thus subjecting yourself to this drawdown. You would instead maybe short markets, okay, invest in other assets, potentially invest in inverse ETFs that make money when the market is in a drawdown. And so this objection, if we think about this from a rational standpoint, doesn't make any sense at all because we don't know what the market holds. Okay, we can't predict the market. Instead, what we can do to take advantage of drawdowns is something called opportunistic conversions. And I previously recorded a video. I'll link to that video in the upper right-hand corner here. Now, the idea here is that if we set a portfolio target, meaning that when our portfolio is in a given level of a drawdown, we perform an opportunistic conversion, we can supercharge our conversion returns. Now, here's where this strategy can be so powerful. Let's say that our portfolio is down 25%. Okay, let's say we're in March of 2020 and COVID is taking a toll on markets. Now, if we think about this, when we are performing a Roth conversion strategy, we are setting a marginal tax rate where we are comfortable paying taxes today in order to avoid higher taxes down the road. Well, if we're in a 25% decline, in a sense, we are in a 25% discount for our conversion rate. Because again, if we perform a conversion at a 25% discount and the market recovers, that recovery is happening within our Roth IRA. And so conceptually, this transforms tax brackets as well. If we're at a 25% decline, and we're viewing this as a discount within our Roth conversion strategy, converting at 22% means we're actually converting at 16.5%. 24 and we're converting at 18, even moving up into the 32% bracket, being a little bit more aggressive with conversions. Now we are converting, in a sense, at 24%. And so converting at a discount can allow us to be a little bit more aggressive with our Roth conversion strategy and potentially allow us to convert into higher brackets. Now, we will still be paying 32% if we're converting at 32%. But when the recovery happens within our Roth IRA, in conceptual terms, we're actually converting at a much lower marginal rate. And so anytime we come across a strategy or an observation such as this, where we find that there is a benefit to converting at a discount, what I like to do is inverse that idea and see what other observations and conclusions that we come to. And so if there's a benefit to converting at a discount, inversing this idea and converting at a premium is essentially destructive. And so now we see how this idea of this catch-up trap comes into play with this opportunistic conversion and premium idea. So in the majority of years, we expect our portfolio to grow. There will be certain years where we have the ability to perform those opportunistic conversions. But if we're performing conversions at the end of the year, oftentimes, most often, we are going to be converting at a given premium. And so again, we can transform rates and now see how we're paying higher rates in a sense if we're converting at the end of the year. Let's say our portfolio grew 15%. Well, all of a sudden we could perform conversions at much lower rates if we performed conversions at the beginning of the year and made a much larger dent within our tax-deferred accounts than if we left those conversions to the end of the year. And so how can we avoid this conversion catch-up trap? I would urge everyone watching this video to set up a rules-based systematic conversion strategy. Really, with any area of your retirement, be systematic and rules-based. So for instance, are we going to convert opportunistically at a given drawdown trigger? Are we going to convert a portion of our given Roth conversion amount in January and leave the rest till the end of the year? Or leave the rest until we see an opportunistic conversion period? I would urge all of you to diversify your conversion strategy. Don't pigeonhole yourself in one strategy where you're always converting everything at the beginning of the year, because then you may be missing out on the opportunity for opportunistic conversions. And perform opportunistic conversions, but don't depend on them. In the next 5 years, let's say you're performing a 5-year conversion strategy, we can't guarantee there's going to be the opportunity to perform at a drawdown. This is something where, again, it's opportunistic. We want to take advantage of it when we see that opportunity. Okay, the big message here is don't predict. Don't avoid a conversion this year because you think the market is going to crash next year. Again, we talked about that doesn't make any sense. Okay, if you actually believe the market is going to crash, adjust your investments accordingly. But at the end of the day, we don't know that there's going to be a market crash. We could see market highs for the next 5 years. So stay systematic with your conversion strategy. Now, it's important to note that not all retirees can convert at the beginning of the year. They have various tax hurdles that they need to make sure they avoid at all costs. And so they'll have to wait until the end of the year. If that's your situation, unfortunately, you'll just have to wait for future opportunities to have more of a split strategy. The big message here is Roth conversions aren't as simple as they look on the surface. There are a lot of details to these Roth conversion strategies. Now, we've recorded videos around developing a better Roth conversion strategy, when to time given Roth conversions, where to pay Roth conversion taxes out of. Now, if you're not yet subscribed to our channel, highly recommend hitting the subscribe button down below. We will continue to release videos on how to improve your retirement, whether it be tax planning or investment planning. And by hitting the subscribe button, you'll be notified of all future videos that we release. If you like this video, if you could please leave a like below, it'll help other retirees find this video just like yourself. And always remember, you don't need more money, you need a better plan. Hopefully this video was informational, and we look forward to seeing you in the next video. Have a great rest of the day.